By training, I'm a scientist. I originally started as a biochemist. I also have a degree in public health because I thought it would be really interesting to kind of apply my science experience in a social context. For a variety of reasons, I ended up working in some relatively heavily engineering-oriented activities, primarily involving pollution engineering, but I decided that I really wanted to go back to law school because I really began to understand that as I went through my career that there were very few people who understood in the area of the law how it was we were going to translate the impacts of science into social agreements. And a lot of the disputes that have emerged over time in terms of understanding how we should as societies manage environmental issues are really fundamental misunderstandings about science and about how society interprets science and how they reflect their expectations as a social organization in the formation of the law. And if one is interested in those things, where does one find oneself? Shockingly, in many cases, not only in diplomatic or policy-making areas, but in insurance. Why? Because insurance fundamentally serves a very broad social role. It is the ultimate economic shock absorber. Generally, what you find is that when there are losses that are experienced by society as a result of unexpected or unintended events, or where there is economic disruption, the first place that people look is insurance, especially in emerged or developed markets. And when the capacity of the insurance industry is exceeded, the next place they are is at their public policymakers' doorstep, asking why it is that they didn't have enough insurance to cover this problem. And strangely, every time we have an emerging risk where the magnitude of the emergence begins to exceed the available capital that's committed in the insurance industry, we have changes. And those changes tend to be changes in the law, and they tend to be characterized by the insurance industry as emergence of substantial exposure in the tort liability context, because in the ways that those models have emerged, all of a sudden the loss models need to be recalculated, mostly because the social contract changed. The expectation of society about parties who manage these activities, which science begins to demonstrate over time, create greater risk than society had anticipated, are then tend to experience a change in the social expectation as translated through allocation of liability. So, welcome to climate change. For insurance, my perspective and part of why I was hired at the Zurich in terms of addressing insurance issues is because my job is to make sure that there is communication between scientists, underwriters, and lawyers so that we can learn from our experience and share knowledge in a way so that we can better understand risks as they emerge and so we can better use our tool, which is the insurance instrument, as a mechanism for facilitating adaptation and mitigation in the context of climate change. For us, climate change is clearly both that risk and opportunity. I was asked at a very large, or rather influential series of insurance meetings over the last several months about whether I thought, as a person who really is focused on developing climate change related products, we could, as an industry, underwrite climate change. And my response was, not only can we, but we must. Because if we don't, other people will simply design our business for us. And they will set the parameters in ways that we will be told how to run our business rather than being able to frame that business on a go-forward basis. So, dutifully, the other lawyers, my colleagues in the industry, always demand that I remind you that I am not providing any legal advice at all as I speak on these topics, so here's my disclaimer. So are we really insuring against climate change? The title of this session was Insuring Against Climate Change. What does that lexicon imply? I think that we are insuring for climate change. We are insuring in the face of climate change, and we need to be thinking about this in a different way. Because the implication of insuring against climate change is it's something that we can fight and something that can be assigned to someone else. And I think, as was correctly referenced earlier, it is us. It's going to be us. We're going to have to make decisions. We have to make commitments. We have to focus resources and efforts in order to assure that we can facilitate adaptation and mitigation, and they clearly overlap. But how can you do that in the context of the current social agreements and disagreements related to climate change? Well, clearly we find ourselves, whether it's in this country or in others, and I should confess that I spend very little time here anymore. I spend more time overseas than I spend in the United States, although I am a U.S. citizen. But where we find ourselves, irrespective of what continent you place yourself on, is a circumstance where atmospheric greenhouse gases, even in the EU, are largely and remain largely an economic externality. Okay? We find that circumstances that are related to adaptation and mitigation to reduce risks associated with climate change must impact what lawyers call essential services: power, water, transportation, and land use. And funny things, these are the things in developed economies which determine whether your economy is competitive and stable or not. And what that means is generally that regulators and government officials tend to prescribe with great detail the management of power, water, transportation, and land use. And under circumstances where what we are talking about is an industry whose focus is insuring private assets and sending risk-based price signals associated with risks affecting those private assets, when what we're focused on in the science context is a public good, that's preservation of the climate, we might have a little gap that needs to be bridged. When we start talking about carbon as a commodity, it's not a commodity in the traditional privatized sense. It doesn't have any independent market. It is a market which is established purely based on public policy and decision making. It is distinguishable from all other commodities in the sense that most other commodities are controlled by private parties. Their rights and liabilities are defined very clearly under law. Who owns what fossil fuel is pretty clearly defined. Who owns the sun and who owns the wind? Well, probably not so well defined. And if we're talking about converting to a low carbon conversion, to a lower carbon society, what we find all of a sudden is when we are in the business as insurers of assuming rights and responsibilities and assuming risks for others through the formation of contract, that when the law fails to define rights and responsibilities, our contract understandably becomes a little difficult to administer in certain cases. So what we have here is a circumstance where we have a governance gap. And I think what Rick was mentioning is that that governance gap, when it's not filled by statutory provisions or direct government involvement, tends to get filled by judicial activism and judicial decision making. All right? So where that presents itself is generally in a circumstance where we end up with a multitude of mixed public policy solutions. That means that we have a lumpy, bumpy ride in terms of how we're moving forward with managing these liabilities. So that's actually a great place for insurance. It's a risk for us, but it's an opportunity for us if we understand what those risks are, and if we can define them. We can also understand in the context of how to apply those risks, manage those risks to facilitate mitigation and adaptation. But we need to understand that we're doing so in a distorted marketplace, and that the risk profiles must be considered very carefully in the context of this developing circumstance. But what are we seeing as pressure points? Rick alluded to these. We are seeing a multitude of circumstances which suggest that there are strong segments of society that do not accept the status quo. So what? So what is, that means you're going to get judicial activism, you're going to get tort liability, you're going to get ongoing exposures. Where have we seen this before? I would submit to you that this is not the first time the insurance industry has seen this. And in history, the insurance industry has played a very influential and substantially valuable role as we have experienced social change. I would suggest you only need to look 100 years or so or more ago at worker safety conditions. And if you consider what the circumstances were in terms of social acceptability for worker injury 100 years ago, and you consider the development and creation of workers' compensation and employers' liability, my expectation is, although I was not alive then, contrary to what my children believe, I would tell you that it was probably pretty lumpy and bumpy. It was probably a mixed bag of social expectations. There were different expectations based on different actors in the economy about what their responsibilities were. Ultimately, that resolved itself through a social agreement that was reflected in the creation of things like workers' compensation and employers' liability in exchange for an agreement about allocations of risks and responsibilities. And who has administered largely those programs over time? The insurance industry. What value has that provided? That's provided a substantial input in terms of value for improvements of safety and health conditions that not only are good socially, but they are economically efficient in the long run. I would suggest you can also look at property, fire. You can look at boiler and machinery. There are a multitude of people in this who are sitting in this room right in front of me who've worked on those issues day in and day out. And the insurance instrument, if it is applied correctly in these contexts, can be used to find where that overlap is between protecting private asset and benefiting the public good. And so where are we developing our activities? Well, we are clearly very much looking at the emerging tort liability, which Rick looked at. We are also looking at what are the things that could change that calculus about the liability allocation. I think many people in the industry look today and say, no one's ever going to be able to prove causation. There's no framework for that allocation. There's no way that someone could suggest that one actor could be held accountable for climate change. And what I would offer in response is that this is an excerpt from a true cost report which was leaked in February of this year to The Guardian. It clearly presents the beginnings of a very strong framework for defining and allocating liability. In fact, it manifested ultimately in the release of an executive summary for that report, and we await the final data and backroom information, in which they're identified. Now keep in mind what we talked about, premium numbers were thrown around a couple of $1 trillion for property and casualty for the year. This particular report says that today, industrial operations, human actions today on the earth are responsible for $6.6 trillion worth of annual damage. Trillion. Okay? Of that, this report says $2.2 trillion are attributable to the top 3,100 companies, public companies, by market capitalization worldwide. Within those numbers, this report says that 5 industries can be, to 5 industries, 80% of those damages can be allocated, and of those damages, 1.6 trillion are expressly related to climate change. Now, if one were looking for a framework to define the basis for suggesting that there ought to be a change in the social contract, my suggestion to you is there are few people thinking about this who are relatively sophisticated. So it's not just about property models. There are people out there thinking about liability models. So where does that leave us? That leaves us, as I said, as an industry trying to look for that intersection where we can use our products to facilitate mitigation and adaptation, just like we facilitated worker safety improvement conditions overall. So what have we done? There's a long list of these activities. I don't have time to go through what the drivers are overall, but we need to have a market which facilitates communication of risk-based price signals in an undistorted manner. And in the public policy context, keep in mind, there are always circumstances where there are certain sub-segments of the society which public policymakers believe are disadvantaged and need additional protection. With that, what happens oftentimes is that there are spreadings of particular risks which distort the sending of those risk-based price signals. And when that happens, underwriters had better be paying attention to the implications, because once you sever the behavior which creates the risk from the cost of that risk, you desensitize the risk creator and allow them to continue to do things like move into flood zones, lest I say that. So what are some of the things that we've been looking at in our company? We've been looking at providing insurance for carbon credits, basically cross-border transactions, EU ETS, CDMs, CDM projects. We've been extending this. MIGA has also been doing that here in this building. We've looked at carbon credit securitization, securitizing both the primary and the the additionality loans on a cross-collateralized basis for operational projects creating CDM. We've done motor insurance, incentivizing pay-as-you-drive, and discounts for hybrid vehicles. We've looked at a multitude of alternative energies. Insurance, we have a primary insurance product for carbon capture and sequestration, which is basically capturing gas off of carbon emissions from coal-fired power plants and other industrial processes. We've extended our directors and officers coverage to include environmental liability mismanagement coverage, expressly providing coverage for climate change-related claims. We have got green building extensions, which clearly are looking at exactly what was mentioned earlier today. The fact that some of these sustainable materials are actually reducing the risk for the damages insured where others do not. So our models do not basically say we accept lead as a basis for a discount. We looked at resilience on a go-forward basis also. We look at things like water reuse and drought coverage to encourage water management. I'm in the process of working on some very interesting projects related to reducing deforestation involving palm oil and other little sticky projects. And then we've got smart grid and efficiency. So what are we about? We're about taking science technology, engineering, translating that understanding into a mechanism where we can understand the price of that risk, understand how we can insure against damages to those assets, and how we can insure in a way to reflect the price of the public good that emerges in a context where we have an ongoing economic externality. But insurance is a tremendously powerful instrument that I think you need to have a better understanding of as you go forward in the process.